trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels. It's that time again for Coach's Corner. Of course, we have Stu with us and Scotty. Great having you back with us.
Good to be here.
All right. Well, today I kind of came up with a topic based on some things that you have said you encounter with coaching. We know that people sometimes struggle with synthetics or what happens if I do the put, what happens if I take the short position, and it can be confusing. But there are some simple ways to understand that. And these are some of the things that we like to show people so that they're not just bewildered when they're looking at these quote boards of just all of these flashing numbers. There's really easy ways to say, if this is the long position, what does the short position look like? Or if I've created this with long calls, what happens if I used puts instead? And that usually just baffles people. So I know we've talked about this before. We've briefly talked about it in Q&A. So I thought, hey, let's do it for Coach's Corner and help the people out there on YouTube as well. So that's going to be our
Let's do it. Good topic.
So let's do it. So today's Chalk Talk, for anybody who's new, it's a little thought question. We'll come back and answer it at the end. But we're going to do, guys, a little different thing. We're going to do a visual one, kind of a multiple choice. So here is a risk graph for you. This is sometimes called a bullish call three-way. We'll show you how it's constructed later, but right now that doesn't even matter. We're just giving you, this is the risk graph. And we see this a lot in UOA, don't we? Unusual options activity. A lot of times we'll see these three ways. But the question is, which of the following is a short put three-way? Now, you and I can all look at this. Well, okay, that's very easy to figure out. My guess is they're already scratching their heads going, how would you figure that out? Or let me drop it into my platform and see. You're making things way too hard. So here's your choices. There's one, there's a second, and there's a third. So we have an ABC multiple choice. So what do y'all think out there? Jot down your answer. We're going to come back and answer it at the end. But if you are completely bewildered, this is a clear sign you need coaching. This stuff can be made so much easier. But I know that
three-way being a three-legged strategy, multi-legged strategy.
It is a three-legged strategy. Yep, it absolutely is. Yeah, so we can tell that because we have three bends. 1, 2, 3. Yep. So again, jot down your answers. Let's go take a look at how you can figure this stuff out and why it's important. So today's topic is visualizing calls to puts. In other words, converting a call to a put or a put to a call, or long to short. If I have the long position, what does the short look like? If I have the short, what does the long look like? So I'm a big fan of visualizing as opposed to having to get out pencil and paper and equations and trying to figure this out. It's really easy. Yeah.
I think I read somewhere along the way that calls are puts and puts are calls.
I seem to have, sounds counterintuitive. It seems like I've heard that before. I think we had a number of topics on that. But you're exactly right. That's a little bit of the insight
that they're really the same thing. And we're going to show you how
So
you
keep that in mind, everyone. Right? They're really the same thing. It just depends on the hedge that you put.
if you want to delta hedge them with positive deltas or negative deltas.
Yeah.
And that we're going to find out. That's a little clue to how you can convert these things very quickly in your head. So let's start with converting long to short. And again, what we're talking about here, I've got a long call. I've seen my risk graph. What would it look like if I did the short call or the trader on the other side? Or if I have a short call, what would a long call look like? How can I flip back and forth? All right, so that's what we're going to start with here. And then we're going to look at where we can combine these. So converting long to short, how do we do this? Well, we've talked about this so many times in Q&A, Stu. The key to understand is that the buyer and seller are on opposite sides of the trade.
Let me get in here for 1 second.
Sure.
And this is such an obvious statement that oftentimes the most obvious gets lost in translation.
So true.
You got to remember, there's always going to be a buyer and a seller. Otherwise, there's no trade. There has to be two sides of the trade. So, it's like what's good for the goose is good for the gander, right? There's always going to be the other side. If somebody's a buyer, somebody's a seller. Somebody has a risk graph that looks one way. The other side has the risk graph that kind of looks the other way.
The other way.
It just has to be that way. There's always two sides to the story.
Right. We've talked about it before. If you use it as an analogy, like with a football bet, if I bet on team A, Stu is obviously betting on team B. We can't both take A. Well, if A wins, that's good for me, and it's bad for Stu.
Yeah, I can't.
If B wins, it's good for Stu, it's bad for me.
Right, you can't have both.
If I lose $10, you automatically know that Stu gained $10. Everything is opposite, and that's so important when we're talking about options. The gains to the buyer are losses to the seller.
Exactly. So when people say, how can I do this but not lose any money? The answer is you can't. As long as you're taking risk in the marketplace, there's going to be that element of win and lose. If you really want to take a no risk position, then go buy a T-bill. But that's a different story here. As long as you're taking risk, there's going to be an appropriation of risk that you have to be willing to accept.
Yep. So any area of a risk graph that's a gain becomes a loss. That's the key insight.
Yeah.
So once you understand that, if I have positive delta and Stu's on the other side, I know he has negative delta. If I have positive gamma, I know he has negative gamma. If I want the stock to go up, I know he wants it to go down. So again, this should be obvious, but we find that a lot of people are completely mystified by it. But that is the single key to understand. So let's go find out. You ready how to do this? I know you guys know how to do it, but let's show them. Here's our risk graph for a long call, kind of our hockey stick graph. And our profits and losses are on the vertical axis. All right, so this zero line right here is break even. We don't gain and we don't lose. But notice that we have gains above, we're into positive numbers, and we have losses to the downside. So I can see that if these are stock prices, if the stock price goes up, my risk graph starts getting into positive territory. So I can look at this and go, I don't know what a long call is, but I can see that the owner wants the stock to go up. And if he goes down, he's got limited losses. All right, but what about the trader on the other side, guys? What's going to happen to these arrows over here?
I think they're going to go that way, right?
They're going to flip. All right, so now think about this. How could you get this picture to flip? All we have to do is visualize. If this were a piece of paper, we're going to take it, we're going to flip it from top to bottom, or bottom to top, take your pick, north to south. All right, so here we go. Visualize. There's your risk graph. We're going to just spin it right on that horizontal axis, and here we go. And there's your short call.
Which is the other side of the trade.
See, I've actually drawn this to where we are physically looking through the back side of the paper here. See
Nothing
if we
changes,
go back.
Right? The numbers are all the same.
Numbers are, yep. There's the long call. We flip it from top to bottom. There's the short call. Now let's try it with a multi-legged position. Here's our long vertical call spread. All right, so everybody wants you to do this on YouTube there. Think about it. You're going to flip it from top to bottom. What's it going to look like? All right, so here we go. We grab our paper and we just rotate it, and there is the short vertical call spread. If I'm the long call, I'm bullish. I have limited gains and limited losses. If Scotty is the short call, he must be bearish. He wants the stock to fall. That's good for him, but it's bad for me. See, everything's
this is true, assuming that you're using the same strikes.
Well, yeah, but in terms of the correct, but in terms of the shape, you're going to get, that's the main thing, is to understand what's happening to the shape of the graph. Yep. So these are going to be, you're just on the opposite side of the trade. All right. So does everybody see? It's very easy, and that will work for any risk graph. You take a long position. If you're trying to visualize the short, just flip it top to bottom. And if you forget which direction, remember that these are your profits and losses. Those are going to be opposite. That's why we're flipping top to bottom. We're making the profits losses and the losses profits.
So okay, Bill, you're saying we can get the same outcome using calls or using puts.
And we could also, right, you could take the short call spread, and we're going to find out you could also take the long
instead of long.
Yep. And so this is another good little exercise to help people with their synthetics. Okay, so that's the way you can convert long to short, short to long. And let's go find out how we do calls to puts. But first, please check us out, marketrebellion.com/get started. We have a lot of great free tutorials, free videos to help you get started. I can't emphasize enough, it's super important that you get a good foundation. There's a lot of nonsense, believe it or not, on the internet, on YouTube, people teaching options that really shouldn't be teaching. We want to make sure you get a good foundation. Okay, so let's go take a look at converting calls to puts. So remember, we looked at long to short. Now we're going to do calls to puts. And we're going to find out we can actually do all of the above. So how do we convert calls to puts? Well, remember that calls make money, generally speaking, as the stock price rises. Puts make money as the stock price falls. So what we're going to do is to reverse the horizontal axis, the stock prices, and that will convert calls to puts or puts to calls.
Let me just say that
sure.
That's a general statement, everyone. I mean, most of the time that's going to be the case, and that's the outlook. I mean, you're gonna use. I got to be careful here. So the call, if the stock goes up, it should make money. You know, whether it does make money or not is a different kind of story. It depends on time, vol, all kinds of stuff.
Right.
But generally that's the case, right? It's the right to buy versus the right to sell on the put side of things. So don't take it verbatim here.
Well, no, what I'm showing is that at the expiration risk graph is going to show that calls are bullish, that they want the stock to go
absolutely
up. That might have been a better way to say it. The puts want the stock to go down. So all we're going to do for this little trick, we're going to flip the horizontal axis. All right, so here's our long call. So remember last time we were flipping north to south because we were trying to make profits, losses, and losses, profits. Now we're trying to make stock prices up being stock prices down are actually better. We're going to flip the horizontal axis. So remember, these are the stock prices. All right, rising stock prices to the right in green, falling stock prices in red. We said that the call option likes to get into the green. It wants to see the stock price rise.
You know, Bill, maybe we should take a second and just say, like, when we look at these P&L graphs, when constructing these P&L graphs, it's always going to be, unless otherwise stated, which I don't think I've ever seen it otherwise stated, stock prices are always going to be on the x-axis, and the P&Ls are always going to be
correct
on the y-axis.
Yeah, that's
always. That's just point. You know, the stock is moving up and down, and the money is moving vertically as the stock moves up and down.
Correct. Yep. So we can see again that if the stock moves in this direction, that we are now getting to higher and higher profits. All right, and because there's no end in this, no other bend that could change this risk graph, it's just going to keep making money as that stock price rises. If we head this way, once we hit our strike, I can see that that's a 100 call. We flatten out. We have limited losses to the tune of $5 in this case. So if we were instead looking at the 100 put, what's the risk graph going to look like? Well, all we're going to do is to reverse this axis. Up becomes bad, down becomes good. So now you're going to take, if this were a piece of paper, you're going to grab east to west, and you're going to flip this way, left to right. So if this is our long call, what's our long put look like? There we go. All right, do you see how we're going side to side, left to right? There's the long call. We flip left to right. There is the long put. All right, so now let's try it with a long vertical call spread. We have purchased a call spread. What would happen if we bought the put spread? What's that risk graph going to look like, guys? Any takers? Anyone? Stumped?
Oh, I'm sorry. I thought you were talking to the people.
No, they're not going to answer.
Oh, okay. So we're looking at the long vertical call spread. Go ahead. What are we doing?
Yep. What's happened if we do the long put spread?
It's just going to be the other way.
Yep. Now notice we're not going to the short like we did last time. That would be moving it north to south. We're just going to do.
Just flip it that way. There you go.
Yep. So there's the call spread long. There is the put spread long. Now we do have to be a little careful here. It's the shape, because you wouldn't buy the 100 put and sell the 105 put. You would actually buy the 105 and sell the 100, but it's to get the same shape is what we're trying to visualize.
Which is the long vertical put spread. If it were the other way, what Bill just said, it would be the short vertical put spread.
That's exactly right. You'll start to see these things are very connected in very simple ways once you understand. And that's really what we're trying to show you here. Okay, now that we've got the basics down, let's make it more complicated. And before we do, please visit us at marketrebellion.com/get started. So the question we want to ask now, because I think a lot of people might have been able to do that in their heads just from trading calls and puts, but does this technique work for complex positions?
Oh my God, a Rubik's Cube?
It's not quite that complex, but some people will think that it is.
Gotta love it. Nice.
All right, so here we go. Let's take a look at a strategy called a bullish seagull. This is an actually older term for it, and I've chosen it because sometimes you'll hear a throwback to it, or people try to make it sound like it's some new strategy that makes all the gains and never loses. It doesn't matter what it's called. I want you to be able to look at the positions and say, what's the risk graph? Okay, so here's the bullish seagull. We're going to sell an at-the-money put. We're going to buy an out-of-the-money put. And we're going to buy an out-of-the-money call. And typically, you're trying to do this for a net zero, meaning no cash outlay. So, for example, let's say the stock is 100. We sell the 100 put. I might buy the 90 put, and I might buy the 110 call. Now, also notice we are buying an extra wing on top of a vertical spread. That's one way to look at it. This could be a vertical spread, right? We're selling a put spread, and we are buying an extra call. We can also look at it as this way, as the calls and puts, and say that that's a strangle. So it's a strangle wrapped around a naked put. Again, synthetically, lots of ways to see these things. And if for all of you out there in YouTube land can't look at this and see different ways, how are you ever going to hedge, roll, and morph it?
That would be a problem. I think, I'm just kind of looking at this. I think the easiest way to look at this might be the first way. Just short put spread. Yeah,
short put spread with a
put spread, and you're buying a call.
Buying a call on top of
it.
Keep
it simple.
So here's the short put spread. There's our strangle, right? Here's our short strike right there at 100. We've got the 91.10. And if we were to combine these, you've got both of these trades. Let's call it, we have a strangle and this at the money put short. This would be the risk graph. So we can also see that there's our short put. There's our long 90 put. That's going to give us the negative deltas on that, or actually to flatten them. And then we've got our long call up here. Now, as Stu said, we can also look at it as a short put or a long put with a extra wing on top of it. So again, you have to be able to look at these in lots of different ways.
The wing being, everyone, the out of the money call. And there you go, right? There it is.
So that's where the strategy gets its name. It's supposed to look a little bit like a seagull in flight. All right, now again, hold that thought. We're going to come back. We're going to revisit that and compare it to another strategy called a Super Bowl. This is sometimes called a three-way strategy. We see this a lot in the UOA trades a lot, unusual options activity. You're going to have a long vertical call spread, say a debit spread, and you will have the sale of a put to finance or to assist with financing the vertical spread.
I'm not a fan of that, terminology, Bill.
Oh, I know. We've talked about that one before. Now, this usually means it's going to be an out-of-the-money call spread, usually, if we're going to try to pay for it, and the sale of an at-the-money. We're trying to sell something that has a lot of value, trying to pay something for something that has less value. So let's say that our stock is 100, and we buy the 105, 110 vertical spread for $1. So notice
Out of the money call spread.
Out of the money call spread, and that's why it's relatively cheap. And we're going to sell the at-the-money, but let's say it's trading for $3. Now, in this case, we have a net credit of 2. That's just the net between these two. So there is our put. There is our out-of-the-money call spread. And the reason that we're trying to sell this put is to shift this entire vertical spread above 0, or at least above that strike. Okay, so remember, here's the stock right there. And when we put both of these positions on, we get this. All right, so that's the Super Bowl. Now, Scotty, I know you've seen different ways of approaching this. What would be a way, like, how would you, if you just saw that risk graph, what would come to mind that what somebody's doing with that? What are the trades?
Well, they are trying to profit between 100 and 110.
Yeah, trying to. Yep.
Anytime you have a fixed reward, that plateau at the top is defining this finite reward around $6.
Yep.
Usually someone is expecting the stock to not necessarily make a significant move higher. They're expecting the stock to make a moderate move higher. And in between 100 and 110, and with that comes a little bit of a higher probability of capturing those gains.
Yeah. The problem that I have with this terminology, calling it a Super Bowl, if somebody says I am super bullish, I'm not thinking that they're limiting these gains.
Yeah, no, that seems counterintuitive.
I know.
Absolutely.
I think they're super bullish because they're willing to accept unlimited losses. But if you're bullish, this isn't even going to come into play. So again, I find this terminology to be not real good. But again, the reason I chose it is one that you used to hear of back in the day. It's because I don't want people to get caught up into the names. I want you to look at the risk graph. So the thing I would see is that this is a vertical, long or short, and that this is a short put underneath it.
You know, Bill, it's funny that you mentioned that. In almost 30 years of trading on the floor of an options exchange, I don't think any broker ever came into the crowd saying, "I want to do the Super Bowl."
Super Bowl, yeah, it's right? One you don't. It's one you don't hear a lot.
Yeah, I mean, it's definitely out there. But the point that Bill's making here is, it doesn't matter what the name is.
Doesn't matter.
It doesn't matter what an iron condor is. It doesn't matter. They're all just names. It doesn't mean anything. You have to understand what it is. That's what Bill's trying to talk about here. You know, where are the risks? You should be able to look at this. You should be able to build this, and you should be able to look at
that until it's a vertical spread with a naked put under it.
You ask Scotty what he's thinking. What the thing that I'm thinking is, whoever's putting this on, are they paying attention to the left side of this graph?
Mm-hmm.
That's where the issue is. The issue is on the left side of this graph. What happens if the stock falls out of bed? Are they prepared for the consequences without a quantified a loss number associated with it? The upside, look, we're all here to make money, and you make some money, but the downside is the risk problem.
Yep. So that's the main thing is, again, don't get hung up on the word. I want you to look at the graph and say, okay, I can tell what it is. Now, every strategy has a counterpart. Every candlestick pattern has a counterpart. So if there's a super bull or a bullish candlestick pattern, you can bet that there is a bearish one as well. So the super bear, same idea. We're going to have a debit spread, sale of a call. It's a call this time to finance that. And again, usually means out of the money put spread. Same trades that we've seen before. So let's say that we buy the 90.95 vertical put spread for 90 cents and we sell the $100 call for $3.50. That would be a net credit of $2.60. And if we do that, this becomes...
okay, go ahead.
Yeah, go ahead.
No, I was just going to say, as Bill's showing this, what I'd like everybody to be picturing.
Oh, picturing in your head. Oh, yeah, sure.
Right? This is what I do with my coaching calls, right? I want you to see.
Sure. I can construct that as we're going. I say, okay, here's this. I've got that. Once I see this, I can build it in my head. Yeah. And it's not hard.
I want you to visualize the graph before you actually see the graph. Right.
That's
When
right.
you can do that, you're making some progress. That's really
That's
good.
when this
right?
stuff is going to be so much easier. So again, one of the things we like to show that there's a real need for coaching for those who are serious about their options trading. If you find what we're showing you here bewildering, again, this is not meant to be a training class. It's meant to just show you a technique and some of the things that we like to teach. So here is a super bear spread. All right, so now here's the big question. Ready, guys? That was just to give a little introduction to those two strategies. Let's look at a super bull spread over on the left and a bullish seagull over on the right. Now, I can't help but notice I see some similarities here. I see a vertical spread here. I see a vertical here. I see unlimited gains here, but I see unlimited losses here. So they are somehow connected, but I can't quite figure it out. It's so confusing until we think of what? Well, let's convert calls to puts or puts to calls. Let's convert long to short. And we can do that visually. So one thing I'm going to look at is on the left, I have the flat part on the right side of the graph, right? If we draw a vertical line in here, the flat part's on the right. Over on the left graph, it's over on the left. I've got unlimited positive deltas over here on the left. I've got them over here. I'm sorry, not unlimited, but I have positive deltas on the left, and I have positive deltas on the right side of the chart. So it seems like there's something with the calls and puts here that's opposite. So one thing we could do, it doesn't really matter the order, but one thing that I'm going to look at, what if we converted this from calls to puts? What's this going to do to this graph over here? Do we flip it north to south or east to west? Calls to puts or east to west. We go left to right.
You got to go this way.
Yep.
Think about what he's doing here, everyone, right? If you go this way and then you go this way, you're going to have the other one.
Yeah, so let's do that. Let's take it one step at a time. I can visualize there must be a super bear because I've now built it with puts. Right, here's with calls. Here's with puts. Now we're getting closer. Now I've got the flat part on the left, flat over here. I've got my deltas. What do I need to do now to make a match? What do I need to do?
The other way, this way.
I need to go north to south, which is making it the short super bear.
There you go.
So there we go. I can quickly see that a short super bear is the same as a bullish seagull.
And you can do this with any.
Can do this with anything. Now, just for fun here, Stu. Actually, let's go ahead and answer our Chalk Talk question. So there's our bullish call three-way, also a super bull. Which of the following is a short put three-way? You can just tell people like, I have no idea. Well, you can look at that and should be able to quickly tell. It's that one right there. All right. So again, if you're one of these people that just find this so confusing, there are super easy ways to visualize what you're doing. That's when you're going to see. How did Bill
know that? Right. All he did really was just go this way.
top to bottom, left to right, or left to right, and then top to bottom. However, and if you don't know, play around with it and just eventually
play with it. Just play with it. Yeah. Practice.
So now, just for fun, we don't usually do this here, but we got a couple of minutes. Let's put it to the test, guys, should we?
Go ahead.
All right, I've got Microsoft here at 418. We've got 30 days to expiration. I'm going to sell, let's do the 415 put.
You're going to do a simulation here. Nice.
We're going to do a 415 put. So let's sell the 415. We're going to do a Super Bowl. All right, let's sell the 415. I'm going to click on the bid. Now I need to buy an out of the money call spread. All right, so let's add an option. We're going to buy a call. The stock is at let's do a 420. And then let's sell the 425.
Beautiful.
All right, so this should be our Super Bowl. Let's go check our snapshot analysis. This is going to be really embarrassing if it doesn't work out, Stu, but there it is. There's our Super Bowl. Now, this curved one is the current curve.
Today.
That's today, but it's going to eventually collapse on that Super Bowl. Now, based on what we've learned, if my calculations are correct, if we change calls to puts, let's go call, put, we should do what? Flip to the bearish side, and there she is. We have a super bear. So far, so good?
It's amazing, isn't it?
Now let's go back and do the short position. So the short position means it's just the opposite. So what's going to happen to these buttons over here, guys?
Just flip them over.
Flip them over. Sell becomes buy. Buy becomes sell becomes buy. And we should see a seagull and fingers. And there it is. There's our seagull. So it absolutely works. And again, if you find that this is so confusing, it was equally confusing for all of us.
And start with one option.
Start with the calls like we did. Just do those.
A call, a long call, a short call. Yeah. Flip it around, turn it over. It's the other side of the trade.
Yeah. And that's when when you start seeing things in 3D, as opposed to, well, let's buy a call because I think the stock's going up. Oh, it didn't. Let me close it. Let me try again. That's not options trading. You need to stay in the position. As Ryan always says, you got to be in to win.
In it to win it.
But what you have to do is to morph the positions and hedge as things change, which they're always going to change. And if you can't look at these and figure out where your hedges, rolls, and morphs are, you're not trading options.
You know, I had a client that we had a session last week, and they had what she described as spend a ton of money on education.
Oh, yeah.
And the educator said to them that options are a static entity, that they don't change, that they are just, it is what it is, and that's it.
Unbelievable.
And I couldn't believe what I was hearing. I mean, I just couldn't believe
I was talking to
somebody out there that can say that.
I had a similar incident. I was talking to a broker one time who was working with a client, and he said, the client was asking, well, you know, let's say the stock is 100. He said, why would you buy the 95 call or the 90? Because he's saying there's, you know, this intrinsic value. And the broker said, oh, you wouldn't. Those are just trading because they were out there trading when the stock was lower, but there would be no reason to buy those. And I'm listening to going, unbelievable. But it's out there, and these people probably have YouTube channels and want to show you how to trade options.
Yeah. The point is just be careful.
Be real careful you get your info from.
Be careful.
So we got two of the best right here. We have Scott and Stu. I know you guys have amazing trading careers, and Stu was 29 years as a specialist and market maker on the Philex. So if you're looking for some invaluable coaching, these two are it right here. So please give us a call at Market Rebellion. And any closing comments, guys?
I would say that along the lines of be careful who you're listening to, be careful who you're listening to. Be able to see the risk, be able to feel it, know where your holes are. Find the holes.
Yeah.
You know, start with that. Find the holes. What Bill did today was like an avenue, a path to find the holes.
Sure.
To think about, you know, how to look at the other side to help you find the holes.
Right.
It's understanding what an option does. You know, somebody like Ron used to say all the time, Ron Ianieri, an option is an option is an option. It's going to do whatever it's going to do.
Right.
And it's all kind of defined based on outcomes and time and implied volatility and interest rates and dividends and, you know, all that stock price groovy stuff. Right. And then you just add another one on top of it. Well, we call it a spread. It doesn't mean anything. It's just another option that does something. Right. And together they create a net. Then you add another one. Then you add another one. They're all just names. It doesn't mean anything. Every option is an option that will do what it's going to do. Yeah. You have to be able to visualize what it's going to do so you can find the holes in case it doesn't work.
So on a related topic, we get this a lot. People say, what's this iron butterfly I hear about? Well, why do you want to trade it? Well, it just sounds like a really cool strategy. I'm thinking it has all the gains and doesn't have any losses. You know, people like these fancy sounding terms. When you look at it, you'll say, all right, it's just lots of ways we could look at it. Short straddle with a strangle wrapped around it. There's different ways. We can look at it, two front facing vertical spreads, debit and a credit. Don't worry about the names. All right, Scott, any closing concepts or comments?
Yeah, when it comes to understanding more complex strategies or you know, being short a call versus long a put, I think it always helps just to remember, you know, what your risk is, and when you're selling an option, you have undefined risk, an unlimited amount of risk. When you're buying an option, you have a limited amount of risk, and that's limited to the cost of the option that you bought. And that's really a good starting point when you're delving into spreads and complex option strategies.
That's great commentary.
That's a really good starting point. Just remember, when you sell an option, you have an unlimited amount of loss.
And right, a naked option, but also you're on the opposite side. If I buy a call option, I've got unlimited gains and fixed losses. If you sell the call, you're on the opposite side. You have unlimited losses and a fixed.
No matter what the strategy is called, like I have this strategy in my head that people throw out at me all the time called a cash secured put.
Yeah.
It's just a name.
It's just a
name. Tell me how to define the risk in that. Tell me how to quantify what your dollars of risk are going to be. Can't do it.
Yeah, don't get caught up in the labels or the terminology. You understand the Greeks, understand the risk and reward and potential probability.
If you can't look at that and see how that's constructed.
Somehow all these strategies correlate to birds and animals. And
they're called that's actually collectively called the wing spread family, because those wings of butterflies, and actually back in the day they had the condors, albatrosses, pterodactyls. Now we usually call them a split strike or 3-strike split, 4 strikes. You just count the number of strikes that you're splitting. But again, don't worry about the names. So I hope that gives you some guidelines to start thinking about.
Yeah, good one, Bill.
And for anyone who is serious about making money with options, please check us out at marketrebellion.com, and we'll look for you next Thursday on Coach's Corner.
All right. Take care.
See ya.